Hey everyone, Rob B with Rob D, and you are listening to the Property Podcast. And this week we've got a mortgage expert on our show. So much is happening in a mortgage market right now. You absolutely need to be on top of what is playing out. So this week, with the help of Kelly Rule, we give you that knowledge.
Welcome to the Property Podcast. Thank you for joining us. Now, if you're new to the show, you may not know that Rob and I advise a multi-million pound property fund. You can find out more about that at portfolio.co.uk. And we've put together thousands of property transactions over the years. In this show, we bring you all the knowledge that we've gained along the way for free, but we also bring you more than just our knowledge. We like to bring along guests who are the absolute leading experts in what they do. And today is one of those episodes. There is so much you're going to learn about mortgages in this episode, so don't go anywhere. And as an extra reward for sticking around to the end, in Hub Extra, we've got a book recommendation for you, which has completely changed how I think about money.
So the news story of the week, for me, is big news. And it is big news, but it hasn't really made big news because right now there is so much going on in the news. What am I talking about? Well, I am talking about the interest rate rises. Yes, the Bank of England have increased the base rate from 0.25 to 0.05. So doubling the base rate. Now, that normally would create attention and have people talking about it. But because people have been talking about energy bills and obviously everything going on in the world right now, it hasn't actually had that much press or that much coverage. It's almost like stealthily happened. But we're talking about it here because you, as property investors or future property investors, are going to be impacted by interest rates going up. Because if you're on a tracker, a mortgage that's tracking along with interest rate, then your mortgages have just gone up. If you're looking to get a new mortgage right now, you may be having to pay a little bit more. However, we've talked about this multiple times on the podcast that because of competition right now, the banks are accepting lower margins. So I don't actually think it'll be that bad for mortgage prices and what you're going to be paying in the sort of near future. Yes, there's an initial reaction to a rate rise, but then the margins tend to come back down again as competition increases. I think it's also important to remember that as recently as the beginning of 2020, interest rates were at 0.75. So we're not into, new highs of recent years. We're not actually as high as where we were at the beginning of 2020. And the Bank of England have indicated that they are likely to raise interest rates again in the future. So what does this mean for you as an investor and what should you do with your mortgages? Well, that will come down to your strategy. There isn't a one answer suits all here. If you don't intend to refinance in the medium term, if you don't intend to sell your property in the medium term, then maybe a longer fixed product might be the way to go. Of course, speak to a mortgage broker, get their advice as well, talk to them about your strategy and make sure you're set up in the best way possible. But yes, we've had a rise and it's most likely going to be the first of a few. Where we'll get to over the next 6 to 12 months of interest rates, we'll wait and see. But I think it's reasonably safe to say at this point that it's going to end up higher before the year is out. We'll see. Before we get into all the juicy news that we've got for you, and we've got some good stuff this week, we've got something that is also good stuff. In fact, it's great stuff. It's the Property Hub magazine. Now, you may be aware of the Property Hub magazine. You may be not, because we don't talk about it that often. But it's actually got thousands of subscribers. It's super popular. Yes, you may love our podcasts and you probably indulge in our YouTube offerings and the Property Hub website. But if you're not subscribed to the magazine yet, well, as far as I'm concerned, Rob, you're missing out because it's brilliant.
It is, and if you haven't discovered the wonders of the magazine for yourself, then you can go to propertyhub.net/magazine and subscribe there. But if you are already fully aware of how wonderful the Property Hub magazine is, you can gift a free digital copy of it to a friend. So all you have to do is get them to go to propertyhub.net/friend referral. If you get your friend to go there, propertyhub.net/friend referral, they can claim a free digital copy of the latest issue, and they will automatically, into the deal, get free access to everything the Property Hub has to offer, including all our online courses, our access to our forum, and our Hub Extra newsletter. They get all of that by going to propertyhub.net/friend referral. So note that link down, send it to them in your WhatsApp group or whatever, and they will thank you because you've just given them the gift of some wonderful free property education. It's wild times in the property market at the moment. Prices are soaring, demand is off the charts, but there's also lots of discussion about inflation and the possibility of interest rate rises throughout the year. This makes it the perfect time to have a discussion about the mortgage market. So important for property investors always, but especially right now. But while we can talk a decent game on mortgages, we are not in the market all day, every day. So for today's episode, we're bringing in a true expert who is.
Yes, we've got in touch with Kelly Rule from Fired Finance, and we do a lot of work with Kelly with Property Hub Invest, and that's because she and her team are true experts at what they do, even for like tough cases like expats. They are really, really good. Kelly herself has been in the industry for 15 years, and I've met Kelly. I've been taken through like a presentation by her previously. Her knowledge on the market is second to none, so who better to have on this episode? So to kick things off, it's the start of 2022. We wanted to ask, what's the state of the mortgage market like right now?
Do you know what? I hate to use the word unprecedented, and I'm using my fingers in quote format when I say that, as I feel that this word has been thrown around there like there's no tomorrow. But the market is still experiencing a period of uncertainty. There's no word about it. Lenders, especially in the buy-to-let space, are still pricing keenly, and we are still seeing further reductions from some, which is reassuring. But we are still in a pandemic, and not even the best economists of our country can predict what the industry will look like in 6 weeks, let alone 6 months' time. We've never experienced this before. We are still seeing valuers value cautiously due to this, which is affecting some applications, especially if the borrower is relying on minimal funds towards the purchase. And we're also seeing significant delays still with solicitors. A lot of firms are working from home or are short-staffed due to isolating, things like that. Altogether, this is having a knock-on effect on timescales. We're starting to see an improvement, but we are still a way to go on this.
So what does this mean for investors out there who are looking for finance options?
Lenders are taking more risks, such as increasing loan-to-value limits back up to 95%, for example, for owner-occupiers, and typically 85% for buy-to-let products. They're also relaxing on certain documentation that they were insisting on at the beginning of the outbreak, which is starting to make applications easier to handle. But I guess it's just that market uncertainty that's still happening in the background, which is causing those delays.
So what kind of documentation are they relaxing on?
So at the beginning of the pandemic, we had a number of lenders that stopped lending altogether. We had a couple that were lending through that first 3 months especially, but they ramped everything up. They perhaps asked for 10 documents initially pre-COVID and were now asking for 20. And that could have been for portfolio landlord. Rather than the normal 3-page business plan document, they would then want an add-on of another 3 pages of how you were going to handle the pandemic if your tenants weren't to pay. And they literally would want to know your inside leg measurements, including bank statements to prove savings for surplus cash funds, just in case you had a void in rent, a lot of things like that. If you'd had a bounce back loan or a CBILS loan recently, some lenders weren't even touching you. Even if you hadn't spent it and you were just holding it, even if you'd paid it back. Whereas as we've progressed over the last year or two, we're starting to see a lot of that ease up. We've gone back to now pretty much documentation to what we were seeing pre-COVID, where we're just, for a portfolio landlord, just wanting to see a basic business plan, more of a tick box exercise. No lender is really asking, what are you going to do if your tenants aren't paying? If they feel that you're buying something that may be a little bit of a jump for you, for example, if you're a first-time landlord, they may ask for a proof of 3 months worth of voids, especially if the property isn't let yet. But again, we're starting to see that ease up. And as long as the valuer is confirming that there's a decent demand for letting and for sale, if needs be, then they're quite happy just to carry on business as usual. So it's really refreshing to see all of that starting to ease up, especially as we were coming out of the pandemic, as we thought at the end of last year, albeit we've now kind of hit a bit of a stalemate, haven't we? So it's just kind of riding that out, I think, and eventually we will start to see an element of normality depending on what happens in the grand scheme of things.
So people might be borrowing as an owner-occupier, doing buy-to-let in a personal name, or doing buy-to-let in a company. Is lending getting easier for everyone across the board?
From my experience across the board, it is getting easier on all 3 scenarios. The only thing that's not getting easy, or we're still seeing, is the delays on the time frame. But again, that's going to ease up as people start to perhaps return to the office or they improve their processes for working from home. We're then not going to see so many cases of isolation where you've then got people having to self-isolate. That tends to hit the valuers more so, because obviously where they're having to go out to a property to inspect, if they're having to isolate, they can't do that. So that then leaves a block of a week in their diary that they have to leave free, and they've then got a knock-on effect for further inspections they need to book, and it just causes a delay right the way through all applications for everybody. So that's going to start to get easier eventually, but that's just still where we're seeing a bit of a sticking point at the moment. But from a criteria and a rate point of view, I would say, and getting an application secured, that is getting easier across the board.
The fact that it's becoming easier for investors is great news. But what about those investors who took mortgage holidays in 2020? Are those borrowers being penalised?
Luckily, it seems to have all been forgotten about now. We used to have to ask that question on every application, but now because we've got a year that's passed, as long as lenders can see that all credit and secured debt specifically has been paid in full and on time and rent being achieved, and they're quite happy and quite comfortable because it was such a long time ago now. We're not even being asked the question, thankfully, because we were going through a stage where we were under the impression from the government advice right at the outset, if you remember, that actually take those payment holidays, take the bounce back loans. They're there to help. They won't hinder any further borrowing. And then we went for a very short period of time where actually it was. And as mortgage brokers, we were pushing back on this because we were telling clients from the advice from the government to utilise these tools. They're there to assist. So when we were then getting kickback from lenders saying, well, sorry, we can't help you because you've had a bounce back loan, it just didn't sit right with us at all. But luckily, that shape shifted quite quickly and that eased fairly soon. That probably only lasted for about 6 weeks or so. And we don't really hear much mention of it now. The only thing we are seeing now is if a bounce back loan has been taken and they haven't repaid, and they're now starting their repayments on that bounce back loan. Some lenders are taking those repayments into consideration on an affordability basis, but I'm seeing that more so on commercial applications as opposed to buy to let. So I wouldn't be too worried too much about anybody who has utilised the tools from a bounce back loan, CBILS loans, payment holidays. As long as you've got a good explanation, as long as your tenant's still paying, then we should be okay to secure lending on that front.
That's definitely good news. So it seems like things are returning to normal, even if it's a slow return. Are there any products in the market right now that have got you or investors excited?
Absolutely. I mean, the new fashionable product that dominates the market at the moment is the green product range. I'm sure a lot of people have heard about this. This is typically for any new build property who has an EPC rating between A and C. You can benefit from a more competitive rate and arrangement fee.
So for investors shopping around at the moment to buy or refinance, what kind of rates should they be aiming for?
For an investment property, it's safe to say we can secure rates from as little as 3%. We always err on the side of caution, though, especially during a volatile market. Therefore, I recommend calculating your numbers at 3.5%. And if the deal still works for you at this level and we manage to get you a cheaper product, then that's extra cash in your pocket. The difference between buying in limited company and buying in personal names. This is quite a hot topic at the moment. 99% of our clients tend to be limited companies because of the tax advantages that you can secure. We've got rates at the moment starting at 2.59. So there is quite a difference. That's on a 2-year fixed. 5-year fixed, maybe a little bit more. I think our cheapest on a 5-year fixed at the moment is about 3.04%. But again, they're changing weekly, even at the moment, which is nice. We still find that they're quite on the high side in comparison to what we were seeing pre-pandemic, but we are starting to see those reduce down. Hopefully, fingers crossed, that carries on and we kind of get back to where we were before all of this happened, which would be really nice to see.
Now, we're hearing a lot of concern at the moment from people who are worried that the Bank of England will increase the base rate throughout the year to help battle inflation. If that does happen, what do you think that will mean for mortgages? Will rates rise, or do you think the lenders will need to stay competitive?
So I think with my lenders, rather than further reductions, I think we will stick and we'll plateau for a time being. I think they'll ride out to see what happens. And then I think they'll then, if the base rate then increases again for a second time, I think they'll then start to creep up slightly with their margins. Again, this is my opinion. I'm not an economist. This is just purely from where I'm sat in the market and my experience. Who knows what's going to happen? We have never been in a pandemic, have we? No one knows. And that's why I get asked this question daily.
So you've got interest rates rising and there are investors right now coming out of a fixed period. What does that mean for them? And also there's investors who are locked into their products who may start to panic because interest rates are going up and they see their costs potentially could soar when the fixed period actually does end. So what do you advise there?
I tend to advise my clients to go with a fixed rate, especially at the moment, whether that be typically in our market, it's a 2-year or 5-year fixed rate is what tends to be on offer. Whether you go 2 or 5 is probably more in line with the client strategy as to whether they are looking to build their portfolio quite quickly. And if you have multiple properties, then having to refinance every 2 years can become quite an expensive option. The fact that you're paying arrangement fees more frequently. However, if the rates do come down, then you benefit from a better rate. And if values do go up, you benefit from being able to get a capital raise out. Whereas if you're actually looking for more longer term capital growth on the property, and that's your strategy and you're not looking to buy aggressively, then maybe the 5-year fix would work better for you. You can keep on that 5 years. You've got that security that you know your rate's not going to move for the 5 years, especially if you're perhaps a bit more of a first timer. And you can then ride that wave knowing that you're secure. And if the rates do go up behind the scenes, then you can sit there comfortably, hopefully, fingers crossed, until you come out of your 5-year fixed. I guess the only downside is then if rates have gone up by the time you're coming out of your fixed rate period, then you're going to have a little bit of a shock because your rates and your repayments are going to go up. My advice to any landlord, as I'm sure all landlords do anyway, is to keep a cash buffer. And you're going to be wanting to keep a cash buffer of around about 25%, ideally, to cover your portfolio. But that's 1 property, 10 properties, 20 properties. You're covering yourself from any unforeseen maintenance costs and unforeseen circumstances like your interest rates increasing. So as long as you're covering yourself, you've got the savings there, then you've then got that peace of mind that if rates do go up, that you're covered. What also helps at the moment, since the last credit crunch, so anybody who's been investing in property pre-credit crunch, back in the 2009 financial crisis, anyone who was investing at that point, we saw a lot of disappointment because mortgages were very highly geared. There wasn't really any stress testing happening at that time. Post-credit crisis, the FCA came in, and now it's fundamental that we are stress testing every single product and mortgage application that goes through on an investment basis. So we're making sure, especially if you're taking a 2-year fixed, that your rental recovers your monthly mortgage payments plus an extra 25%, sometimes 45% if you're buying in personal names, at 5.5% interest rate. So even if you're securing a 3% interest rate, the lenders will stress test that up to a 5.5% interest rate to make sure that if rates were to go up, your rental is going to cover that, to cover any unforeseen circumstance. So there shouldn't be any shock then coming out of a fixed rate whereby rates have gone up. With a 5-year fixed, we tend to stress test at pay rate, and that's purely because you're fixed for that 5-year period. So there's no worry of the rates increasing because you've got that security there, but they still insist on that 25% buffer if you're a limited company, or sometimes 45% if you're personal name, just to give you that reassurance.
So property prices going up right now, we know that, but we also know, thanks to the property cycle, that at some point, we don't know when, but we know that at some point they will fall again. So with that in mind, from a mortgage broker's point of view, what can people do to weather the storm whenever it comes?
That's a really good question. Who knows when this crash is going to happen? It could happen in 6 months' time. It could happen in 6 years' time. No one knows. I say business as usual. The only thing I would suggest is don't overgear yourself, especially if you're looking to buy multiple properties. We've got buy-to-let lenders now back up at 85% loan to value, which is great to help budding investors get on a property ladder if they only have a minimal deposit. However, it gets more risky when you're in this territory and you've got high lending secured against a property. My advice would be try and stick at 75% loan to value. And I typically stick at quoting all deals at 75%. And I will mention to my clients that more is available. However, your rate does jump up massively when you go into an 80 and 85% arena, which what tends to put people off. And I try to remind them that you don't want to over-egg yourself. If you've got some property which has got equity there, and you're coming out of your fixed rate period, there's no time like the present to be able to actually get some of that equity out if you can. Whilst we're refinancing, you may as well. You're paying for a valuation, you're paying for an arrangement fee. Let's see if we can get you a capital raise as well. That can go in a savings pot ready to help with unforeseen costs, or that can go into a savings pot ready for when you identify a property that's coming on the market for a bit of a bargain. What I'm seeing a lot of at the moment is clients looking at the falling retail market. Unfortunately, we're seeing high streets are in a bit of a decline at the moment. I know my local high street I'm seeing more shops being boarded up now than ever before because of e-commerce and everything else. They're looking at this as a bit of an opportunity here because they can haggle a retail unit down because there's limited demand. They can get a really good bargain on it, and they're actually taking out a bridging loan and applying to change the planning consent to residential and converting it into houses or flats. And again, when we start hitting a time of uncertainty and there may be a slight crash, that's when you can get some, unfortunately, it seems a bit unethical, but people will be selling at lower price because the demand's not there, and that's when you can tend to sweep up a couple of bargains from that point of view. So it's always a case, again, just having that cash buffer, having those funds available so you have the ability to do that if you're wanting to improve and increase your portfolio, that is.
So what about negative equity? This is quite a common concern. What if a property price falls that it puts you into the realms of negative equity? Is it a cause for concern? Or is it a case that your rents are covering your payments? It's just a paper loss unless you sell, and there's nothing really to worry about.
I would suggest to ride the wave. If you're looking at your portfolio, we've gone through a crash, and you're seeing that a number of your properties, if not all of them, are now in negative equity, and you have the ability to carry on maintaining your mortgage payments because your rental is in excess or even on par, then try and keep hold of those as long as you can. Now, who knows what the future is going to hold? Let's hope, fingers crossed, we're never in this situation whereby you've got a negative rent situation, because at that point you may not have no other option but to sell. But like I said before, where we're doing the stress testing now, it's going to be very difficult for you to be in a negative rent situation. The market is going to have to crash significantly for you to be in that situation because of all of the calculations that the lender takes on board, that we do on your behalf, obviously. Now, when you're buying a property, it's going to be very unfortunate for you to ever be there because we wouldn't have lent on it in the first place. So hopefully that reassures investors that if there is a crash imminent, that we're doing the whole market is doing the best we can to avoid you getting into a situation where you're not going to be able to cover your mortgage payments.
No, we're big on making predictions here on the Property Podcast, and we like to get our guests to gaze into their crystal ball as well. So what do you see happening in the market over the next 5 years or so?
I get asked this question so often. And again, I can only go on what's happened in the past. I mean, the pandemic is not too dissimilar to the credit crunch. It took 5 years for us to come back from a credit crunch, but we haven't seen as much of a downturn in the market with the pandemic like we did back then. We didn't go into a recession, fingers crossed, touch wood. We haven't gone into a recession. And in my opinion, I don't think we're going to. I think we're going to see, and I think we have seen a slight crash in the market, but I think that's more so because of valuers valuing cautiously. I don't think that's because it's a lack of demand. I think the stamp duty holiday helped because we had so many people buying to make use of saving on stamp duty land tax. So that kept everything afloat. So again, we were kind of plateauing. And I think as we come out of the pandemic, I think budding investors and homeowners alike are going to have the reassurance now that they've been holding off putting their house on the market. They've been holding off buying their next investment property or their first investment property because of the market uncertainty. Well, now actually we're out of the pandemic or we're on the brinks of coming out of it. We can now buy. And that's, I think, naturally just going to drive the market upwards in the right direction. So I think that's what's going to happen over the next 2 to 5 years. I don't think we're going to see a recession in that time frame. But again, I'm not an economist, so please don't shoot me down, but that's just my personal opinion. Outside of that, who knows? Recessions do happen. And we could see one in the next 10 years for whatever happens in the market then. But I think, honestly, in the next 2 to 5 years, I think we're going to be comfortable and we're going to see a good upturn in the market.
Well, a huge thank you to Kelly for bringing all her knowledge and so much of it to the Property Podcast. The mortgage market right now is an exciting place. As you've heard, there's so many lenders out there right now. There's so many options. But with so many options, you really need to know what you're doing. And we recommend, whether it's Kelly or anyone else, working with an expert is the way to go. Rob and I have worked with mortgage brokers through our entire time as property investors, through good markets and not so good markets. It's worth paying for. It really is. And Kelly is not paying us to say that, nor is any other mortgage broker. It's just that mortgage brokers, the good ones at least, are worth the money. They certainly are. Something else that is really worth it is Hub Extra, and that's probably because it's free, so it's not hard to fight against the cost, because we look to give you more at this part of the show, whether it's a book, a hack, a resource. We just try and leave you with upgrading your life that little bit more before the podcast ends. And this, of course, is backed up by the Property Hub Extra email that goes out each and every Friday. If you want that, sign up to the Property Hub website. Again, completely free. A bit of a no-brainer if you haven't done it already, because you can access all the courses and all the other good stuff that's on the website. And, of course, you'll get the Hub Extra email. And this week, Rob, I love it when we have this. We have a book. And you've read a book, and you're recommending it. So tell me more about it.
Yeah, this is a book called Die With Zero, and it's written by Bill Perkins. I'd heard this book recommended several times. I've heard it on a podcast, I think maybe a couple of times, and I resisted reading it because I thought I got the idea from the title of what it was about. I thought it was going to be one of those books that should have been a blog post. You get so many books like that. You can get the idea out in about 1,000 words, but then it feels the need to fill a couple of hundred pages. But my friend Noel said that I really should read it, and I did, and I'm so glad I did. It's a really great book. Essentially, it's about getting you to think about how you spend your money now and across the course of your life. And the idea, as you will get from the title, is that you should aim to have spent everything you've got by the time that you die. And that's not just about having selfish, leaving nothing to your kids, leaving nothing to charity, having the best time you possibly can, but it's about doing all that stuff while you're alive rather than waiting to the end. And I could go on about this for absolutely ages. I won't. I'll just give you kind of one insight from it, which is that actually it makes the point that a lot of people like to maximize the amount of money that they've got all the way up to the point they die, because they want to then pass that on to their children. So they save their whole lives. They spend as little as they can in retirement. They don't want to sell the family home. They want to just keep hold of everything so they can pass it on to their kids. But he makes the point that if giving money to your kids is that important to you, then why are you leaving it to chance? And you are leaving it to chance because you don't know when you're going to die and you don't know exactly how much money you're going to have when that is the case. So if it is that important, it would make far more sense to think about an actual amount of money that you wanted to give them and a time when it might have the most impact to them. So maybe when they're in their late 20s and looking at buying a home or whatever. But the point is that people kind of hoard money because it's for this very important reason. But if the reason is that important, then you should actually be thinking about it and doing something differently. And if it's not inheritance, you could take the same view to charity and all manner of other things. There's so much more to this book, and that's kind of my point of recommending it. It really does get you thinking. It's a simple idea, it's a simple concept, but the book develops that concept really well. And it's one of those books that can really jolt your thinking and get you looking at a wide part of your life in a completely different way. So let me pass on the strong recommendation that I was given and that I really benefited from by recommending it to the Property Hub audience and to you, Rob.
Well, interestingly enough, Rob, I was aware of this book, as I mentioned to you before we started recording. But again, wrongly, it seems, I'd assessed the title, kind of thought, okay, I can pretty much get the gist of what this book's about and dismissed it. So based on your strong recommendation, because you always give me good book recommendations, I will add this to my list and I will consume it this year. So thank you. And thank you for listening. We're done for another week. We'll be back next week to make you a power user of a very important property platform. So make sure you join us for that, because why would you not want to be the best at what you do? Next week, we're going to make you the best. So that's next Thursday. On Tuesday, we'll be back with Ask Rob and Rob, so join us for that as well. And if you can't get enough, check out the socials, Property Hub UK. On any of the socials, that's our handle. And Rob mentioned Portfolio at the top of the show. If you want to check out more about Portfolio and our wonderful app, then go to portfolio.co.uk. That's us done. We'll be back Tuesday and Thursday. We'll see you then. Bye-bye.
Bye-bye.